Good night, Andrea.
Hi, good night.
Good night, and thank you for returning tonight.
Good night.
And each and every one of these, for each and every one of us, it was very trying this weekend and also today and for the next coming days, weeks, maybe months. We're not sure exactly how long this is gonna last. So let's get into things. And I'm gonna the first thing I'm gonna do is a recap of what we did last week. So the topics we covered, we did an introduction. And this gave us the reason why we should do bookkeeping. We continue with what is a business, a description of what is the business. All activities whereby you earn an income on a regular basis are called businesses. Then we went on to give a description of the sole proprietorship, which is a business owned by one person. The partnerships, which is a business owned by two or more persons. Example of a partnership using Gemma and Diane. One person have the money to buy the fish, and the next person having the skills, and together they came together and form a partnership. We talked about the company and about the fact that the company is a separate and legal entity, and that the assets of the company are separate from the owners, and about the fact that you cannot take up the assets of the individual to meet the debt obligations of the company. Then we went into a definition of bookkeeping. We talked about why you should keep records, the importance of bookkeeping in your business. We talked about how bookkeeping would make a difference in your business. For example, it tells you how much money you have received, how much money you have spent, and how you have spent that money. We talked about how it will make a difference to your business. We also spoke about the advantages of record keeping and the disadvantages of record keeping. Then we went on to some documents that you should use in your business. And we spoke about the cash book. Then we gave ideas of how to roll up the book for a cash book. And I gave examples of how to record the information into the cash book. Then we spoke about the inventory records, and I gave an example of how to keep inventory records. We spoke about the creditor book. We also spoke about the debtor book. We spoke about invoices and the fact that when you are going to sell items on credit, you should use an invoice. You should issue an invoice which itemizes all the items that you have purchased and the individual cost of each item and the total amount that is due to you. We spoke about the labor book, and this is the book where you record the information relating to persons who are working for you. And they give you examples of pay sheets. So tonight we are going to go on to it. We are going to go on speak about the double entry system and about the books used in accounting. So the definition of the double entry system, The double entry system of accounting or bookkeeping means that for every business transaction, the amounts must be recorded into two separate accounts, where you make an entry for a debit or a credit and a credit. So for example, in the double entry system, every time you make a transaction, a debit occurs and a credit. For example, if Gemma was to go to Gustin to purchase fish for his boat, then in that transaction, there's a debit and a credit. The money that Margaret pays to Gustin, he would record that as a debit. And the item that he sent out to her, which would be fish, you will record that as a credit. So you give her fish, so that leave your business, so that's considered the credit. You receive some money from her, that is considered the debit. These transactions are entered into a book called a ledger. The definition of the ledger. A ledger is a written or computerized record of all the transactions a business has completed. These transactions are recorded in the ledger in different accounts. And here's an example of a ledger. And as I told you before, in the ledger, for every transaction that you make, there's a debit and a corresponding credit. For example here, we have for the rent expense account, we have a debit here because the amount of $10,000 was received for rent. On the accounts payable side, the $10,000 as a credit will show that the money went out. So the money was paid out and it was received into a rent expense account. At the bottom here, we have an accounts payable account. So the cash is shown here as a credit because the cash was paid out and it was received into an accounts payable account. Therefore, we have a debit on the accounts payable account. Profit and loss account. From the ledgers, the items are usually recorded into a trial balance, and then the information is transferred into a profit and loss account. And this is what I was talking about when I was talking about the income and expenditure statement. A profit and loss account is a financial report summarizing the revenues, costs, and expenses a company or business incurs for a specific period. Usually the profit and loss account is prepared monthly, quarterly, or annually. The profit and loss statement demonstrates your business ability to generate profits. So when you take your profit and loss account or income and expenditure account to the bank, the bank can see whether you are making profits or not. And this tells the bank whether or not you will be able to pay the monthly payments for that loan that you are asking for. And this is an example of a profit and loss account. Is this clear? Sorry, that's clear. You can see this clearly? Hello?
Yes, please.
So this is what a profit and loss account would be. So you will record your sales under the heading sales and the cost of goods sold. So then you will have the gross profit. This is the total amount that you you have earned, and then you will subtract your expenses. So your expenses will be costs for things like if you have to pay electricity, transportation costs, items that you purchase like bags, like knives, those kind of things. Those kind of expenses are considered expenses, and they will be recorded into this bottom part which says overheads. You can use the term overheads, or you can use the term expenses, and these expenses are subtracted from the gross profit, and then the balance we have remaining here is your profit or your loss. Because in some cases, it can be somebody's asking a question.
No, sorry about that. I signed in. I signed in on the computer, so I was seeing the screen big. So I signed into the phone to make sure everybody else can see F is big, but it's not all that big on the phone. So that's what. Sorry.
Okay.
Mhm.
All right. And then from the income and expenditure statement, the items are recorded into the balance sheet. And the balance sheet is a snapshot of the financial position of a business at a specified time, usually calculated after every quarter, 6 months, or 1 year. Balance sheet normally has two main heads, assets and liabilities. And this is the balance sheet. Now, the assets are the items owned by the business, and the liabilities are the debts of the business. So, for instance, if you own the boat, you might have you might own a building. You might be renting an office, or you might have an office, and you might buy furniture for the office. You might buy some equipment. You might buy a printer, laptop, computers, and you might have also a vehicle that you purchase for the business. All of those are considered your fixed assets. Your current assets would be the stock that you have, and that would be the fish that you have in storage. Any cash that you have in the bank will be considered your current assets, and your accounts receivables. Your accounts receivables are monies owed to you by persons that you have given credit to. Cash and the balance at the bank, the amount of money that you have on cash that you have at hand and the balance you have in the bank account. Those items are considered your current assets. And your liabilities would be if you have a loan, if you are paying a loan at the bank for the vehicle, that would be considered a liability. And that would be also not just a liability, that would be considered a long-term liability. A current liability would be accounts payables, and your accounts payables will be persons that you have to pay, that you have purchased items on credit from, and you still have to pay. That is what is considered accounts payables, and that is considered a current liability. And normally, a current liability is a loan, is a debt that is due within a year. A long-term liability would be something like a loan where you have the bank to give you a number of years to make the payments. Now, today you can buy a lot of this is not done this way today because there are a lot of accounting programs available like at PAC, and Gustin, you was telling us about another program. Gustin,
Yes, please.
right? What was the name of the program you was telling us about?
All right. Give me a minute. Let me just minimize this. All right, I can tell you shortly.
All
My
right.
screen is going so big.
But to go on these accounting programs, you have all of this information today takes place in the background. So all you have to do is enter your information into the program, and then you can produce your income statement and your balance sheet from the program. And you can either you take that information and take it to an accountant, and this would be in the case of a business. You will take this information to your accountant, and he will use this information to produce your financial statements. For the sole trader, the bank would accept the information that you pull from your accounting program. But for obviously for a company, they would expect they may expect audited financial statements.
Okay, so one of the apps is Plan Maker.
Plan Maker?
Yeah, when you download that app, it gives you two other ones. Along with it is Presentation and Text Maker as well.
Okay. So that is the program that he just told us about. That is an example of one of the accounting packages that have available that can be used for small businesses. As I told you, and normally a bookkeeping course takes from between 6 to 12 weeks. So we can't actually go into me showing you how to record financial transactions into the ledgers, and then to the trail balance, and to the income statement and the balance sheet. It will take you some time.
Andrea, Christina is saying she uses the Wave app that I was telling you about as well.
Yeah.
Which is a free, free software.
Shall you say who you say? Christina?
No, Christina in the chat, yeah, she was saying that she used the Wave app.
Oh, okay. Okay.
A user-friendly type software as well that assists with these things.
Right. So you just have to sit down when you have time and enter it. Of course, you have to record your information daily, as I told you to record the information, and then you will put this information into your accounting program, and then you'll be able to generate your income statement, your balance sheet, or whatever it is that you request you need to take to the bank.
The app that you're all talking about, that's the one Wave Finance, right?
Christina?
I think that app is a good app, though. I think
Yes.
that's actually a small business app as well. Yeah.
Okay. Now, what is profit? Profit is an investment gain or reward that business owners aim to get to reflect the risk that they take. Profit means that there is more money coming in than there is going out. Income exceeds, in short, it says that income exceeds expenditure. Loss. This means that you are spending more money on producing or buying your products than money you earn by selling the goods. And this is an example of a business that is making profit. Sales must minus costs and expenses equal profit or loss. So here you see you have sales of $15,000 less cost of sales, and that gives you your gross profit. And then when you less your expenses of $3,500, you have $5,000. So therefore, this shows that you are making a profit. But if you sell the same $15,000 in products, you have the same cost of sales, the same gross profit, and then your expenses are $9,500. What does this show? This shows that you have made a net loss, not a net profit. Okay, I am going to go to another slide now. And I want to go to another slide. Okay, we're not going to go into managing accounts. The managing of any account of a business is important for the survival of that business's finances. The proper management of the cash flow as it relates to receipts and payments from the company account will help to improve the business financial management system. Also, the management of the books in terms of cash and bank accounts, bank reconciliations will serve as a guide for proper financial management. Managing cash. Now, cash is the lifeblood of your business. If you manage it well, your business will remain strong. Manage poorly, and your business goes into cardiac arrest. And I am sure you know what cardiac arrest means, that your business is in trouble. If you haven't considered cash management as an important issue, then you are probably undermining your business's short-term stability and its long-term survival. How can you manage business cash better? Start with understanding how good cash management practices can affect your company's growth and the survival of your business. Cash flow. Pay attention to your cash flow. The cash flows is concerned with the flow of cash in other words, the income, and the cash out, the expenditure of the business. Cash flows are useful in determining the short-term viability of a company, particularly its ability to pay bills. And this is something that the bank will look at. The bank will look at the cash flows of your business to see if your business is making money and to see exactly what you are doing with that money, because that will determine whether that is going to be one of the determining factors of whether or not the bank is going to give you a loan. Because if the business cannot repay the debt, the bank will not give you that loan. Income is money that comes into your business. Income generally refers to net profit, what remains of revenue after expenses have been subtracted. Most people are concerned with income. This is good, but if you are spending everything you are bringing in to get a profit, then you are just adding work to get more revenue, and there is no benefit. In other words, there is no profit. What is expenditure? Expenditure is money that goes out of your business. Expenditure is money spent, representing the cost of doing business. Expenses may be in the form of actual cash payments, such as wages and salaries, cost of an asset, And that's, for example, if you want to, an asset, for example, for your business would be if you want to buy some machinery. Maybe you might want to buy a boat, or you might want to buy a vehicle to help carry around the fish to sell, or to take the fish from the freezer to your home and from your home back to the markets. Transportation and storage. Expenses are summarized and charged in the income statement as deductions from the income. And we would have gone through that just now when we went through the income statement. You would have seen that the expenses were deducted from the gross profit. How does money go out of your business? Money goes out of your business by purchasing stock and paying for storage. And paying for storage, for example, is for the refrigeration of your fish in the market. Also, from purchasing assets, as I said before. Services like transport. Some of you may have to use a taxi to take home your fish from the market. Market rent, I believe that you have to pay rent for the stalls that you're using in the market, right? Hello? Hello?
Yes, please. Yes, please. Yes, please.
Yeah. Your electricity bills. Remember, I said that if you are storing fish at home in a freezer, if you are doing up your accounting at home on the computer and printing out invoices on the printer you're using home, remember I said that you could a portion of the, you can charge it as a portion of your electricity bill, and that would be considered a business expense. Wages and salaries. Other expense activities such as purchase of materials, plastic bags, knives, office materials. Now, this is for the benefit for those persons who were asking me about salary. Whether you are a sole proprietor, a member of a limited liability company, or involved in a partnership, you need to think carefully about how you take money out of your business. Business owners should pay themselves a salary, and it should be enough to get by. Do not take money out of your business for unnecessary expenses. Your decision about compensation should be based on how much money your business needs to operate moving forward. Business owners should pay their taxes to the Revenue Authority and pay employer payments and self-employed payments for their salary and the salaries of their employees to the Social Security Department. And that is something that we would have discussed last week. Now, how to pay yourself. Now, some of you were asking me last week how to pay yourself. And this is the answer. Make sure that you have enough money for food, shelter, transportation for you and your family. So when you are making the decision to pay yourself, take into consideration your monthly expenses. You know, you have to get enough money to buy food for your family, for transportation to get to and from work. And you know, if you have, For example, if you're paying a mortgage, you may be paying a mortgage, you need to take all this into consideration when you are deciding how much money to pay yourself. If you are constantly worrying about these important aspects of life, it's going to be tough to run a successful business. Now, what are unnecessary expenses? Unnecessary expenses are expenses that people make out of business funds that have nothing to do with the business. For example, are you tempted to buy lunch, snacks, or drink out of the money that you're making daily? Do you think you are to wear clothes at every event you attend? Do you regularly buy nail polish and other beauty products like weave, Remy, and manicures? Then if you are doing these, then these expenses should be paid from your salary. In other words, this money should be coming out of your pocket and not out of the business, because they are your personal expenses and not business expenses, as they do not relate to your business. Any questions so far? Best practice. Always keep business and personal accounts separate. It is not wise to mix your personal money with the business money. Anybody want to tell me why this is not wise? Gustin?
Pardon me? Say again.
It is not wise to mix your personal money with the business money. Why do you think that this is not wise?
Because if you don't separate your business from your personal money, then you would, on when you decide to do anything that's personal, then you'll be dipping into money. Then you would be running the business to the ground.
Exactly. And you would never know whether your business is making a profit or not. For all you know, your business could be making a profit, but you are eating up all the profits because you are using the business's money. Managing credit. Buying and selling on credit is very popular. It can be rewarding, but it can also be very risky, as people do not always remember who owes them money and to whom they owe money and how much. Some people may only pay after a long time or not pay at all. Understanding how to manage credit will help you to better control your business. In fact, it is sometimes better not to sell on credit at all. But if you must sell on credit, keep to the following rules. Only sell on credit to regular customers who you are sure will pay you back on time. And this is important. And this is important because if your creditors, and when I say creditors, the persons that owe you money are not paying you on time, then when it's time for you to go to the boat and buy fish, or if you want to buy plastic bags, or if you have to make the payment to the bank for the loan that you took out, then you will not be able to do this because your customers are holding the funds that you need in order to make your payments. Demand payment of part of the amount. I know for some of you, you may not want to do this, but sometimes it's best to demand a part payment so that if the debt goes bad, at least you would have gotten something. You would not have suffered a total loss. Keep records of people who buy from you on credit. And that was discussed last week when I told you to keep a creditor book with the list of persons making purchases from you. The disadvantages of selling on credit. Your customers may linger in repaying or may not pay you at all. There may be quarrels over repayment, and I'm sure that some of you might have experienced this. You sold customers products, you sold customers fish, and the customers take their time in repaying, in paying you. And then when you call and you ask them, and you have to call and you have to ask them for the money, there's a big noise over it because they don't want you to ask them for the money for the items that they purchased from you.
I live in that now, boy.
You are?
Yep.
But that is sometimes why it is better sometimes not to sell on credit. It can easily add to a lot of money, which makes it difficult for you to remember who should repay you and how much. And this is a perfect example of what will happen or what happens when you are not keeping proper records of the persons who you are selling on credit. As I said before, you can't keep all the information in your head. The money that your customers still owe you cannot be used to purchase stock or to upgrade your business. Imagine fish, there's a fish landing one day and the fish is selling relatively cheap and you want to buy stock to put up, know that it's cheap so that you can sell at a higher price later, and your customers refusing to pay you your money and you lost that opportunity, or you decide that it's time to expand your business, but you have persons out there owing you up to $20,000 collaboratively together owing you $10,000, $5,000, and you need that money to upgrade your business. So that's why sometimes that's an example of why sometimes it's not good to sell on credit. But one of the advantages of selling on credit is that it is a service to your customers and it will attract some customers. Because quite frankly, there will be those customers that will only purchase items from you because you are allowing them to take the items on credit. Right, Margaret? Lisa?
Say that again. I went indication.
Or advantages of selling on credit is that it's a service to your customers and it will attract some customers. And I just spoke about the fact that there are some customers below that will only purchase from you because you will allow them to purchase items from you on credit. But when they have money, they don't spend the money with you. Is that
That
true?
is definitely true.
All right, advantages of buying on credit. And this is a good example of buying, good advantage of buying on credit. To buy stock in a season when it's cheap so that you can store it and sell it when the prices are high. So when the season is high, you buy the item, you borrow the money, get the items on credit, and you repay for the items. And then out of season, where the prices are high for the item, you sell it at that price, and then you make a big profit, a bigger profit. Disadvantages: there may be quarrels or confusion over repayment. You may forget that you owe someone money and the person might think that it's intentional and the end result might be a quarrel. There's a tendency to buy unnecessary items when buying items on credit. And sometimes you have to pay more when you buy on credit because the person will charge you interest charges. I don't know if this applies to you guys in the market. Gustin?
Yes, please.
Does this apply to you?
No, not necessarily.
Okay.
What I can say there, Andrea, is that a smaller person like me will get fish at one price, and somebody like Gemma or Kerwin will get fish at a cheaper price because they're buying more quantities than I can buy. So
Yeah.
sometimes I would get it a little higher, and then we get it a little lower.
Yeah.
All right, I won't put I won't put Gemma in that line because Gemma's get lashes just like me.
Okay.
I just using names as a,
Yeah, I know. But
Yeah.
that's the big boys. The big boys in stall one and them sort of places. Yeah.
All right. Points to note when making a decision to buy or sell on credit. Calculate how much profit you will get with your business. The profit should be enough to repay your credit and still leave some money for savings. Follow these pointers. Try to repay your credit on time so that the people will be prepared to give you credit anytime you ask for it again. Your character standing for repaying credit on time is called creditworthiness. And without your creditworthiness, nobody, and I mean nobody, the bank or nobody, will want to give you anything on credit. And now we are going to go into loans. Because some of you were talking about loans and the fact that the bank don't want to lend small businesses loans. Now, a loan is a type of debt. Well, actually, a loan is a debt. In a loan, the borrower initially receives or borrows a sum of money called the principal from the lender and is obligated to pay back or repay an equal amount of money to the lender at a later time. Typically, the money is paid off in regular installments or partial repayments. Each installment is the same amount. Loans. Owners of small businesses everywhere blame non-availability of loans for all their problems. Experience has shown that in most cases, the real problem sometimes is something less, such as slow inventory management or poor collection of debts. And when I say slow inventory management, I am referring to the fact that sometimes persons can have the inventory in stock for a very, very long time and they are not making any sales for the items they have in store, in stock. And when I talk about poor collection of debts, I'm speaking to the fact that they are not managing their creditors properly and the persons that they are giving credit to are repaying them slowly. So therefore, they end up with cash flow problems. Therefore, whenever a small business seeks loans or complains of lack of money, it is important to examine all aspects of the business carefully to determine whether the money sought is really required. Even if money is required, the following options should be examined before considering a loan. If there is any old, non-moving or slow-moving stock that can be disposed of by offering it at a lower price for quick cash instead of expecting a good price and waiting for it, this can be done. Are there any debts remaining uncollected due to disputes, etc., that can be settled by agreeing to get a little less than what is owed? And this speaks to the fact that if you are not keeping proper records, sometimes there can be disputes between you and some person that you have offered credit to, where you can be saying that one amount is owed to you and the person is disputing this amount. So therefore, sometimes it might be best to settle and come to a common agreement. Disadvantages. Some loans carry a repayment penalty, and these are disadvantages of taking loans. Some loans carry a repayment penalty, preventing the borrower from paying the loan early without incurring additional costs. And I think this still applies to some types of loans in Barbados, that if you repay them too fast, because remember, the whole idea of the bank offering you is a loan is so that they can make a profit on the money that they are lending you. So if you repay the money too fast, it means that they will receive less interest from you, the borrower. So sometimes a penalty can be charged for repaying the loan too soon. Another disadvantage, there are a number of limitations on the transaction. Good credit is usually required to borrow money. You know, sometimes when you go to the bank for a loan, they will send off to the credit bureau to get information on how you repay your loans, how you repay your purchase, and what's not. And sometimes there can be stipulations on how the money can be used. Advantages. A bank loan can be secured quickly, sometimes in less than an hour. A bank loan can be used in several ways. Money can be borrowed for expansion, for mortgages, to purchase furniture, vehicles, or for home renovations. By choosing to take a loan, your money is still there to use in case of emergency. And this is because you are using the bank's money. So any monies that you have there in the bank, you still have that you can take up and use in case of emergency. Now, when you go to a bank or the credit union and you ask for a loan, they will evaluate you using something called the 4 C's of credit. And this is not just for business loans, this is for personal loans as well. And the 4 C's of credit are character, capacity, collateral, and capital. Banks look carefully, and they look very carefully at borrowers because they lend money. especially in tough financial times like these. The number one reason why banks say no to small business loans is credit, both poor credit and lack of credit. Although the general credit principles are the same, lenders look at business loans differently from personal loans. The lender looks primarily at the credit of the business, and this is for a business that is ongoing or a company. That's fine for an existing business, but what about startup businesses or a sole proprietor? In this case, the lender, and when I say lender, I'm referring to the bank or credit union. They will include the credit of the business owner. So your personal credit is something that they will evaluate in this case. If you are a sole proprietor or a new startup business, can you give me a minute, please? I need to find the charger.
Sure, no problem. For Galaxy 810, could you tell me who you are, please? Just so that we can record your participation.
Hi,
Gal-
Shelly. This is now.
Oh,
None of
that's
my
you.
com-
Oh,
Yeah,
oh,
none of my computers working.
oh, okay. All right.
Okay. Because business loans are riskier of any type of loan, lenders are much stricter with their criteria. Don't be surprised if your personal credit history is scrutinized, as well as the credit of the business. What bankers look for in their approval process for business loans can be summarized in the following criteria. The term before season credit. And the first thing that they look at is the character of the borrower. Now, the character refers to the financial history of the borrower. That is, what kind of financial citizen is the person or the business. Character is most often determined by looking at the credit history. This includes late payments, and this is the information that they can get from the credit bureau. Things, places like courts and most banks and most other business places will report delinquent loans to the credit bureau. So they will look at late payments. They will look at your delinquent account and total bad debts. And total debt. Business and personal credit are two different things. Most new businesses have no business credit, so they must use the personal credit of their owners. In such situations as business loans and leases, the owner may need to give a personal guarantee. The bank will also look at the capacity to repay. And the capacity to repay refers to the ability of the business to earn revenues in order to pay back the loan. Since a new business has no track record of profits, it is riskier for a bank to consider lending. Capacity is easier to determine when a business can show a positive cash flow. So when you take a income statement and a balance sheet to the bank, and the bank analyze your income statement and your balance sheet, the bank can tell whether your business is making money. The bank can tell how long you have items inventory in stock. They can tell, for instance, if you are selling items on credit. From that information, they can determine how long it takes for you to receive your money from your creditors. The bank can tell, for instance, how long you are taking to settle your debt that you owe to persons that you are buying on credit. That financial information tells a story on your business. So that is why the bank will need that information. That is why they will ask you for that information. So no matter what you tell the business, the information that you give to the bank will either tell the same story or it will tell a complete different story to what you are telling the bank. So they can't be fooled easily. So capacity is easier to determine when a business can show a positive cash flow. When income exceeds expenses for a sustained period of time, the business has a good chance of getting a business loan. And they look at the capital. And this is the capital assets of the business. Capital refers to the capital assets of the business. Capital assets may include, for example, a boat and equipment, or a vehicle, as well as product inventory. Banks consider capital, but with some hesitation, because if your business falls, they are left with assets that have depreciated, and they must find some place to sell these assets at liquidation value. So you can see now why to a bank cash is the best asset, because for some loans you are required to use cash as collateral. When it comes to items like land or homes, for example, the banks may take these items because the value of land appreciates and the value for a house may appreciate. And when I say appreciate, I mean the value can increase over a period of time. So the bank will be willing to take your property as an asset or your land as an asset to use as collateral for the business. Collateral to secure the loan. Collateral is the cash and assets a business owner pledges to secure a loan. In addition to having good credit, a proven ability to make money, and business assets, banks will often require an owner to pledge his or her personal assets as security for a loan. And that's what we just discussed, that the bank will be willing to take your assets, especially assets that don't devalue, to use as collateral to secure a loan. Banks require collateral because they want the business owner to suffer if the business fails. If an owner didn't have to put up any personal assets, he or she might just walk away from the business failure and let the bank take what it can from the assets. And sometimes the assets may have devalued. Having collateral at risk makes the business owner more likely to work to keep the business going as banks reason it. And we have come to the end of that slide. And we have come to the end of tonight's presentation. And I am now opening up the floor for questions for the next half hour on the business. So it's now your turn to ask questions. Any questions? If there is something else that you need me to discuss, like, I don't know. Now is your opportunity to ask questions.
Good night.
Good night.
Well, I want to give the opportunity to any of the other participants first. Otherwise, I'll go ahead and ask the question. Right, so my apologies first of all for coming in late, but I got 2 devices here, including the phone, and all of them gave me a whole set of trouble tonight. So I wasn't able to get in on them. I came in on the computer and had to come back out. So I didn't hear the early part of the presentation either, so I don't have any comments for that. But I heard you spoke to the you were talking about wait, let me get my thoughts together. You're talking about loans and paying back loans too early. That's one of the things that caught my attention. So you were saying that if you were saying there's a penalty for paying back a loan too quickly because the bank use the loan and it gets the long-term loan to make interest, to make money.
Yeah.
So that if a person for some reason came into some money, and I know that there's an agreement between you, the person and the bank in terms of the lifespan of the loan, whether it's 10 years, 20 years, or whatever. But if a person comes into some money and want to bring down their loan, they might not want to clear the loan for the same reason, but they want to bring it down. One question first is that, would that be a problem even if you decide to stretch the loan out in the last set? So let's say you have let me use 10 years, especially for us as small business. And you decide that for the 10 years I come into some money, I would like to bring down this loan by 5 years. And then you stretch the other five years out. If that will incur a penalty. And second question, if it is that you decide to pay off the loan and it's a penalty that you incur, would it stand in your way of getting another loan if for some reason you wanted to get another loan?
All right, for now, when you apply for it, you would have to ask your bank about this, right? But when you loan, right? The higher the interest is charged on the principal of the loan. So when the loan starts and the bank gives you the agreement, right? It tells you how much money you are borrowing. It tells you the installment, and it tells you how much money overall the loan will cost. So you know how much you will have to pay, right? So the interest is what the bank is expending. So suppose the bank you borrow $20,000 from the bank, right? And you have to pay back 25,000. The bank is expecting that $25,000. The bank is expecting that $5,000 as interest to them, right? Which is a profit for them. So they're expecting that. No, and that $5,000 is guaranteed as long as you pay the loan over the 5 years or 10 years, or how much time they give you to pay the loan. That is how much money they are guaranteed to earn. But if, for instance, you start paying off the loan and I did say that the interest is charged on the principal, which is $20,000. So suppose you take a loan today, you get a loan today, right? Today, the first of April, and you got a windfall at the end of April, and you go to the bank and you tell the bank, okay, I want to pay $10,000 on the principal. It means that the bank allows you to pay the $10,000 on the principal. It means now that you are on the amount owed to the bank. It is less than $10,000 now, because you would have made you may or may not have made a first installment. So if you have paid a first installment, it will be less than 10,000. If you made if you didn't make a first installment, then it may be $10,000. So now the bank ain't guaranteed to get that $5,000 in interest, even if you pay over the 10-year period. Because remember, the interest is charged on the principal. So if the principal is no $10,000, so they are no charging interest on $10,000. So you have probably cut the amount of interest that they were expecting to get in half. You understand? So you will have to ask the bank whether they are willing to allow you to do that without a penalty. You understand?
Yeah. Yes.
Right, so that is why you will have to go into the bank and you will have to ask the bank if they will allow you to pay into this $10,000 towards the principal, which will reduce the amount of interest that they were expecting on the loan. What was the second question?
The second question was if you do pay the money and the bank get that loss of interest, if that will hinder, if it would come as a broken agreement between you and the bank on your part, and then if that was stand in your way of a future loan.
If you go into the bank and you have the discussion with the bank, and the bank tell you, yes, we will allow you to make the payment towards the principal, no, it will not affect your credit there at that financial institution next time or for any other financial institution. It does not impact your credit. What impacts your credit is when you are to make a payment and each month you are making the payments late. Some months the bank has to call all over the place to try to get you. They're making calls and you're not responding when they're making the calls, and months go by and you're not paying the loan. That's how you end up with the bad credit. Not for something as simple as repaying a loan early, because you would have to go in and discuss with the bank about repaying that loan early. That would be an arrangement between you and the bank. So,
but another issue that I find with lending agencies or credit credit scores or something like a problem. Well, it could be a problem. But I was paying for an item at a store, and I was paying um like weekly and keeping up to date with not the loan but for the item. And then so like if you figure you're supposed to pay something on the 27th, but you are able to pay on the 20th, that the person call and say that you owe them. So you figure that you pay for that month. But then they said, you know, what you are really doing is paying down for the item, but you are not um, fulfilling the agreement, which is the date that they gave you. You understand what I'm saying?
I know.
And so that in itself could also cause you to get bad credit. I suppose.
Well, Vern, um,
I don't know if anybody else. I
I know.
don't know if any. I don't know if anybody else
Um,
in the training here ever experienced
yes,
something like that
courts,
with a
courts,
thing.
courts is a place, Vernell, that if them tell you them want you to pay a bill on the 27th day of a month, and you pay before the 27th day of the month, when the 27th day of the month comes to, courts will call you and tell you that that you still owe them. Now,
Yeah,
what is their problem is that they want you to stick to the agreement to pay the 27th of the month because they mean they want their interest. When you pay before, sometimes they're saying that you are not living up to your agreement. And I don't understand why or
yeah.
how comes that is happen. You understand? But I know for
Hmm.
sure courts, I had a problem with that with court. So I can actually say that part is true.
But
Yeah.
Vernell, what I
Hmm?
can say is that you should not have bad credit because of that, because they can store the payment. So okay, if you are to keep to pay courts monthly, and you go in and make the two, and you, because you don't you have the two payments available in June, you go in and you make June and July's payment in June, and you don't make the payment in July. I can see how they can say that, because you did not tell them. What you will have to do is, if you go in and you make two payments in June, and one relates to July and one relates to June, you have to tell them, I am making a payment for June and I am making a payment for July. Otherwise, they will put the payment towards June and you will still owe them for July, right? If you make the payment, if you are supposed to make the payment the 30, the 30th of the month, and you pay the 15th, they can't say you break the agreement, because they can store the payment. In other words, they can keep the payment until the 30th and then apply the payment. So that is wrong.
Yes, Andrea, you are saying that is wrong. I understand you. But courts does that because I don't know what does be the problem there. But sometimes if you go and you pay your bill early for courts, as I say, and say them call you and tell you, well, you drew today, and you say, well, I pay my bill on the 10th. You understand? There, as you said, they might say, well, you pay your bill too early, or like a case like that. Sometimes too, the money don't even log till the 27th. You would say to put that there as a credit because courts got a lot of different ways and means of dealing with your payments. To me, they like to stipulate the day of payment and not to pay earlier. Now, another thing that you said there that was quite so true. And they got some cases that if you pay courts twice in a month and you say that, okay, let me pay this month because I don't know how next month will stand for me, courts will call you next month, although you pay forward that bill, and say that you still owe them for that month, although you pay 2 months in 1 month. That is so true.
Because they will treat the payment as an extra payment for the particular month. So you will have to tell them that this payment is to be applied to next month's payment.
But Andrea, in a case like that, what I'm saying is that if you're supposed to pay a bill $100 a month, and you go and you pay a forward, you bill $200 a month, 1 month, and a month come and you ain't able to pay that bill, you should have that $100 should go as a credit towards a month that you may miss. If you understand what I am trying to say, but some businesses do it, but some businesses don't.
I understand what you're saying it, but some businesses and a lot of businesses will treat it as just an extra amount that you are putting towards.
Yeah, that's true, because what the lady said to me was, then she called me about the payment. Because I usually pay like say the 27th. I was paying the 27th. So like when I get time I go in there, I will pay. So I pay around the 19th or 20th. And then the lady said to me, "No, what you are doing?" I said, "Well, I paid the bill already for the month." She said, "No, what you are doing is that you are paying down. In other words, bringing down
Yes.
the cost, your balance.
Yeah.
You're bringing down your balance, but you are breaking the agreement." So as a matter of fact, she said to me, you can pay the bill either on the 27th or the 29th, which is like 2 days later, but not before.
Okay.
So then it's better that y'all just keep the money, the payment form.
Exactly, but that's what I start doing. I don't pay until the date.
As if you owe them $10,000 and you pay for that time, then to bring down the credit for the $10,000, you will still owe them, right?
They don't want to lose any interest. Any interest due to them.
All right, Andrea, my question to you. Thanks for talking about this. You ever hear about bad wait, that you must have bad credit, or certain places don't want to give you a loan? You familiar with that?
Not that you must have bad credit. You must have it that what they tell you is that because banks, like courts and the banks and different places tell you, and this particularly applies to people that like to buy on cash, that you should have some sort of credit history, not bad.
Somebody actually told me that from a company at time, that I need to got some sort of bad credit in order to be in the system. So at some point in time, you need to like don't pay something at some point in time, because if you're paying too fast, it'd be a problem. And that body actually told me that, because I tend to, like, if I see something I want, I would buy cash. I would save for it myself, etc. But I don't believe in taking out things, because when you take out things, it'd be a risk. And you could buy something for $20,000, let me say from work, and you're working big for 10 years, and then all of a sudden, let me say this over for when people get income, they got no means of income, and you only owe them like $1,000. You know that after the letters come out for a while, and you can't pay the letters, you know that the people coming back and sell where there is that you got for that $1,000.
I get that problem sometimes too, because I tend to buy on cash, and even the bank have said it, that sometimes it's good to purchase items at some point purchase items on credit, so that you will have a credit history, not a bad credit history, but a credit history.
Yeah, Everybody
Andrea,
can put it
Yeah.
wrong way.
what about paying in 3 months and getting that cash price? Would that come as credit too?
Yeah, because don't forget, initially initially you took out the item on credit, but they gave you the option to pay in 3 months, so you will have a credit history. Because
Oh, okay, thanks.
you had to go through a credit agreement. So there's some some place that has a record that you taking items on credit. It doesn't matter that the fact that you paid it in 3 months, you would have taken the item on credit. That is the option that they offered.
Yeah. Andrea, I
Yeah.
remember one time I went to the bank for a loan as a small business person. And what the bank wanted from me, the bank then want to know that I had lump sum of money in the bank. The bank wanted to see my credit ability. The bank wanted me to install all monies I made per day, even if I take it off the next day. They just want to see you putting on and taking off periodically in order to give you a loan. And to me that sometimes that works for you too as credit.
Yeah, I would have shortened the slice for this thing that I did, but that was also included. That could have been also, that's one of the things they cut out, but that's also one of the things they wanted to say, because it is rarely advisable to deposit your money in the bank and then take it off. It shows that you are making money. Even if it shows business transactions. It shows that the business is making money. You put in the money in the bank, it shows that you are making money, you're depositing it, even if you are taking some of the money out of the bank. It shows that you are making money. And those same transactions will go good together when you are taking your financial information, when you're taking your receipts and your invoices, and your income statement, and whatever else you are taking to the bank. That will be support that you need. And it doesn't even have to be from the financial institution that you are going to get the loan, to apply for the loan. You can be going to apply for a loan at the credit union, but you know that you deposit your money and withdraw your money from First Caribbean. You can go First Caribbean, you can ask them for a statement, and you can take the statement to the credit union.
Yeah, it does work for real. It is a good thing to do, even though like sometimes they don't want you to say, well, you gotta bring $1,000 every day. You could carry $100, you could carry $50, whatever it is you made, and you can put it on today and you can take it off tomorrow. It keeps records of you saying you like the business is generating and it's taking off. So it does work.
Yes.
All right, guys.
Question. Gus, can you go ahead?
So the long run now.
Okay. For small businesses, right? Why is it easier to get a loan from a credit union more so than the bank?
All right, Andrea.
Yeah.
All right, right now, let me just answer one quick piece of that before Andrea answer you. First off, the bank and the credit union is two different places. They're that money. Credit union is not actually a bank.
All right, the credit union. The difference is that all of the members of the credit union are part owners of the business. You know that, right? It is your money in the credit union. The credit union is owned by the members. The bank can be owned by an individual person, but the credit union is owned by its members. So that is one of the reasons why it is easier to get a loan from the credit union. The credit union lends the members money to the members. You understand? Vernell,
Yeah.
you understand? So therefore,
Yeah.
when the credit union holds their annual general meetings, you can go to the credit. They provide you with the financial information, the auditor's report, and everything. And you can go to that. You can go to that meeting, and anything that you read there in that book or in those financial statements, you can query and you can question, and they have to answer you because you are a member of the credit union. You are a part owner. It is your money. It is not theirs. So therefore, they have to answer to its members. All right, Gustin, you had a question next.
No, I don't know. All right. Oh, right. All right. So everybody in the chat, be very, very, very careful.
You have to raise your voice, please.
You can't hear me?
Yeah, I can hear you now.
Dropping out.
So everybody in the chat, be very careful with the loans. That's one thing as well, because there are so many different loans, and you've got to be very careful because there's some loans that actually allow you to pay back a certain amount of money monthly, like $500, $1,000, etc. Then there's some that don't allow you to pay back. They just keep taking a percentage out of your money as you deposit it. So you got to be very, very careful with the loans. Make sure that when you're going for these loans, that you read or you ask every question that comes into your head pertaining to these loans. That's one thing. And the next thing is for Lisa. The depositing the money into the bank account and withdrawing it is wonderful. But remember, there got some people that what you will call tax averse. People that don't want to pay a tax or they don't want to put the money through the bank.
Hello. He dropped out.
No, I finished.
All right. I am trying to look for a simple amortization schedule that I can show you. Okay. I'm trying to find a amortization schedule online.
All right, so Lisa, meanwhile, you understand what I mean in the part where the people trying to avoid paying taxes to the government? The reason why they won't put their money into the bank.
You explain it to me a little bit more. When you say not paying taxes, you mean in what form?
For instance, as a registered business, right? So by rights, wherever money that I deal with, I pay taxes on it. Some people don't want to register. All right, let me put it to you this way. The idea when the coronavirus come and they have the country lockdown, the government was stating that they're going to give small business people money, right? Let me say, for instance, there is 5, let me just put it out rough 5,000 business, small business people out there. And this is people that you know, hairdressers, nail techs, etc. You could bet that only 30 or even 20,000 of those people, I mean, no, I say 5,000. You could bet 10 or 5, how to put it? You, I really put it 50,000 people. You could bet that 20,000 of those people only register because they don't want to pay the taxes. So then you won't find them depositing cash into the bank and withdrawing it. They will do the sales, get the cash, keep it, and then, well, some might use the bank, but some would try to avoid the bank.
All right. This is an example of what I was talking about Vernell when he was asking about a loan. So here we have a loan for $100,000, right? The bank has given you 20 years to repay this $100,000, and you are making payments 12 times a year, which is every month, and the interest rate is 7%. Now your monthly payment would be $775.30. Now this is the over a 20-year period, paying monthly. You will make 240 payments over that period of time, right? Now the total of the loan, the total amount you would have repaid the bank is $86,071.74. Now that is the amount of interest that you would pay the bank, right? So this is the amount of interest that you will pay the bank. They expect $86,000 from you. Now look at the amortization schedule. Now this is the payment one. This is the 7,000. You are paying $775.30 monthly. This is the amount of money out of the $775. This is the amount of money that is going towards interest. You see, $583.33, and this is the amount that went towards the principal of your loan, right? So therefore, look, they received this amount, the interest. They put this towards your principal. So now look, the amount that they are calculating interest on now for the following month is $99,000. And as you can see, the earlier part of the loan, the majority of the money goes to interest, and a minimum payment goes towards the principal that is why the amount, that's why it seems that you are forever paying this amount, even though you are paying $775 a month. That's why it seems like you are forever paying this loan, because as you can see, a small portion goes towards the principal. Let me go down to the later years. Now, in the later years, now this is after this is at month 188, after 188 months. So 188 months is over 10 years gone. You see now that they have received all of their interest up front. This is the amount now. The smaller amount is now going towards the interest, and the bigger amount is now going towards the principal and bringing down the amount faster, right? You can see that, right? You see, and as it goes down, less and less is being paid towards interest, and more money is paying towards the principal. Now when you go now and you pay you get a windfall. The next month the loan is now $50,000. You see the interest has been cut in half. You see now that they will now be getting, the bank will be now getting less interest over the period of the loan. So this is the reason why, in answer to your question, why the bank or the credit union or the other financial institutions such as Signia and those places, this is the reason why they might want to charge you a penalty for paying off the loan too fast. Do you understand, Vernell? Vernell?
Yes.
Right.
So question.
They are getting, look, the interest.
All right. So if you go into the bank then, right? So you understand that part. But if you decide that you want to, you pay your same 7, whatever it is you gotta pay towards the loan, that they could get their interest, right?
They can't get their interest, Vernell. They can't get their interest. It is impossible for them to get their interest because the interest is being charged on the principal.
Andrea, I have finished say what I'm saying. I asked a question. I'm asking based on based on the what you just put up there. If it is that you gotta pay the 775 or 70 whatever a month, you can see from that the bank getting the interest for the money for their loan. They're making the interest that they stipulated as part of the loan. The question I am asking is, suppose you go in the bank and you decided that instead of you paying the 775, which is what they are asking you for, you want to pay $8 or even $1,000. Would it amount to the same thing as saying you're paying too much money?
You mean you want to pay?
Would that the extra money that I'm talking about? Excuse me. The extra money I'm talking about now is about going towards the principal, not towards the So I go in and I have my 775. That is what they said I gotta pay. That is what they're taking the interest out of. Yes. But I decide that instead of paying 775, I would like to pay $1,000. I might not have it to pay every month, but I might decide to pay this month because I got a little extra cash in my pocket. But I want that extra money go towards the principal, which is the most money that is slowly moving down in the first 10 years.
You will have to discuss that with the bank. I don't think they will allow you to. I think they will split it between principal and interest when you make that payment. But you will have to check with the bank. Another option instead of doing another option, if you want to, another option that you can use to save. Another option that you can use to save the amount of interest that you're paying is that you can tell the bank, okay, you see this $775, I am going to come in and I am going to pay half of this money at the 15th of the month. Suppose the loan is due at the end of the month. I am going to come in and I'm going to pay you half the money at the 15th of the month. And I am going to pay you the other half at the end of the month. And that could save you, that could help reduce some of the interest that you have to pay. And the bank wouldn't have an issue with that, for sure.
But why, Andrea? But it's two broken up payments in 1 month. Why it would be a difference?
Because the bank is still getting the full amount. The bank is still getting the full amount. There's still the majority of the money is still going to interest, and the amount of interest that they are losing, it is not an amount that they will worry about. To you, you'll be paying less interest, but to them, they will be worried about that amount, because it wouldn't be like if they lose interest off of $50,000 or $20,000 or something like that. So, and I recently asked a banker, a friend of mine, a banker, about that, and he said the bank will penalize you. I said, suppose I spread it over the period because I wanted to get smart. No. So I said, suppose I spread it over the period. The bank, and he's a manager at First Republic, the bank will penalize you. You can't trick them. But hey, the penalty, the amount that they might, the amount of the penalty might be, it might be $10,000 or something like that. There was $10,000 penalty if you're going to save, if you're going to save $40-something thousand in interest, then you shouldn't worry about a $10,000 penalty. You're saving $30-something thousand. You pay them $1,000.
Andrea, hi,
Yeah.
good night. Yeah, I was a time back, a couple years back, I had a loan and I was advised to do it that way by how I used to work and get paid salary, get my salary. And I was advised by the loan officer to pay it that way instead of monthly,
Yeah.
and worked pretty good for me.
You end up paying less interest.
Yes, I did.
Yes, it works, and they allow you to do it.
Right, yes, because I had the advice from the loan officer.
Yes. So there are ways that you can go about reducing the amount of interest that you pay. But I'm saying,
There's another thing to that. When you go in the banks or these institutions for loans, and we small business people is be so anxious sometimes to get this loan and stuff like that, that when we do get this loan and they say the loan approved and they bring all of this documentation to us, we don't ever take time to read it. And that is where our problem does lie, because if we do not read through the fine print, we just encounter a lot of problems then when problems occur, because then they will say, but it was in the agreement. That's
yes.
how you know you don't read the agreement, because it's too much fine print to read, and you just want this loan so bad, you just sign this document. It is not a good thing to do. That is something that we should look into.
Did I not say that just now? Did I not tell you all that?
You should always check the fine print, whether it's a loan from the bank or from courts. If Shepherd or where you should always check, or whether it's a credit card, you should always check the fine print.
All right, Andrea, before you narrow down on the loan, let me ask you a question here now, right? Let me say, for instance, that Easy Bank, Easy boy that loaning one of your fish vendors some money. I want to refuse to pay back the cash. What steps you would suggest I take in terms of getting back the cash?
You as the bank,
You could call me the bank or call you loan you money.
but the option that the bank, listen, banks normally work with their customers, right? Because banks do not like taking up the assets of their customers and selling them off, right?
Mm.
The banks generally work with the customers. It's just something that customers are so stubborn that the bank constantly making phone calls and the customers are not taking the calls. They're constantly sending them letters and inviting them to come in to sit with the loans officer to discuss the loan, to see what the bank can do, and customers still will not respond, right? But after all is said and done, the option is that if they have your assets, they have a lien on your boat or your house or something like that, it might mean that that is what they would have to do, sell the asset. Remember the situation where the lady had a house that was worth well over $1 million, but in the end, the house sold for about half the amount to clear the debt.
All right, so as
Asset,
Vernell,
the bank
as
will go
Ver-
assets.
as Vernell lend me the money now as she working in the market, and Vernell lend me the money now to do something now, and I don't give her back that money. Where she will stand now in terms of the money, would she be a loss, or there's anything that she can do to get back that cash from me?
No, two things. Sorry, one thing. Vernell, when lending out money, don't care how small the amount, should let the person sign a contract, a simple contract between and it could be a simple contract because other than that, it is your word against hers. Sorry to have to say it, but it is your word against hers. So a simple contract, simple promissory note will suffice. And that is something that can stand up in the court of law. But if you don't have anything like that, it is your word against the person's word. And in court, it will come down to credibility.
Yeah, copy, understand.
But for you, Gustin, as a boat owner, and you sell fish to some person, the invoice that you issue to the person, you don't need a contract. That invoice is a contract between you and the person because you issue them with the invoice and they sign the invoice. So that is a contract. So you can get back your money under those circumstances, or you can take the person to court.
Right, understand.
All right. Any other questions? How about anything else?
Not for me. I gotta go and relax.
All right. So if there are no other questions, I will be.
Hello, hello.
Yes.
Ines.
Yeah.
You made a comment there that the lady who hosts was worth $1 million was sold for a fraction of the cost, right?
Yeah.
But I thought that the bank was sell your house or property close to the market price,
Yes, they will. They will.
and so that you don't lose everything. They take
Yeah.
up what is yours and then give you rest.
Yeah. But Mr. Ennis, what happens? What happens if you are not a good customer and you are not working with the bank, and the bank have to go that route, and they can't get close to market value? Then the bank will have to sell it to for what they can get.
Well, that's fair enough. I thought to go the route first, but
Yes,
right.
that's what we would try to get the market value. But if they
Yeah,
can't market value,
Andrea,
yeah,
a bank manager told me on that topic that even if first of all, if you're having problems, you should come into the bank and let them know that you're
Yes.
having problems, firstly. But if it comes to the point where the bank has to take up the house and sell, what she was explaining to me is that the bank is not really in the business of selling houses. That is not what the bank is about. But at the same time, morally, using a little moral, not that they have to, the bank will try to get, as Mr. Ennis say, as close as possible to, they will sell it for as much as they can get their money and try to get something for
customer,
the right, the
customer.
customer, right? They will do that, but they will make that effort. But if it comes down to like when they put it on the market and they're not reaching it, and it's not going to be for no long extended period either, that they will let it remain there. So if it comes to that, they can't get what they're hoping to get for it. They will then try to, their last option would be to get what is theirs for the house. That's what the that's what the lady told me.
Right, that's what I just said will happen. All right. So any other questions, comments? Okay, so if there are no other comments and questions, I trust that everybody had put their email address into the chat for Shelly. And what I will do, I will put together some multiple choice questions, some simple multiple choice questions, and you have until, let me tell you, you will have until the 28th of April to submit your answers. Now I am going to put my email address. I am going to email it to each individual person in these multiple choice questions, and you will have until the 28th of April to submit the answers. Okay?
Okay.
All right. And the certificate will be only issued after to those persons